The IRS has started accepting returns, and we all know what that means. Tax season is officially upon us. But the new Tax Cuts and Jobs Act has some notable changes that will take effect for 2018 tax season, some of which you might not be too pleased with. Here are 8 changes that will most affect your returns. To start off with, your marginal tax rate will likely be lower, as 5 of the 7 tax brackets have lower tax rates in 2018. However, people with taxable income between $200,000 and $400,000 could be pushed into a higher tax bracket. Still, the lower rates on income below $200,000 will offset some or all of the negative effect of being in a higher marginal bracket. This next change will benefit most taxpayers. The standard deduction amounts are doubled for 2018. For example, if you are single or you file separately, your standard deduction will be $12,000 compared to roughly $6,000 in 2017. And if you're a married joint filing couple, you're looking at $24,000 for 2018 compared to roughly $12,000 the previous year. However, personal and dependent exemption deductions, which would have been roughly $4,000 each, are eliminated in 2018. There is now a limit on how much you can deduct for state and local income and property taxes, for a combined total of $10,000 or $5,000 if you use married filing separate status. Keep in mind, however, that you can still deduct state and local general sales taxes instead of state and local income taxes. For 2018, the maximum amount of mortgage debt used to acquire a first or second residence for which you can claim itemized interest expense deductions is limited to $750,000 or $375,000 if you use married filing separate status. It's important to know that this change will only affect you if you took out a home acquisition mortgage after December 15, 2017. Although alternative minimum tax is still in effect for 2018, exemption deductions are significantly increased and phased out at much higher levels. These exemption deductions could mean you can be off the hook for 2018. And even if you're not, you will probably owe significantly less. Under the new tax changes, the maximum child credit is doubled to $2,000 per qualifying child. In addition to this, up to $1,400 of your credit can be refundable. This is good news for you because even if you don't actually owe any federal income tax, you can collect the refund. And your live-in mother-in-law might not be a bad thing after all, because in addition to that, for 2018, there's a new $500 tax credit for qualified dependents who are not under the age of 17. You will not be allowed to make a deduction for moving expenses for 2018 unless you're a qualified military personnel. The same goes for employer reimbursements for moving expenses, which are no longer tax-free. Lastly, itemized write-offs for miscellaneous deductions that were subject to the 2% of your adjusted gross income threshold the previous year are now eliminated. This means that you will no longer be able to deduct unreimbursed employee business expenses, investment expenses, tax-related expenses, or union dues. In addition to this, you are only able to deduct personal casualty losses if they are due to a federally declared disaster. Keeping up with all of the new tax changes can seem overwhelming, but it is important to stay informed in order to avoid mistakes that could end up costing you big time later on.